Today we are going to talk about something that most people dread. Insurance. Yes, I know, insurance is boring, expensive and complicated. But it's also very important and can save you a lot of money and hassle in the long run. An insurance policy is a written agreement between the insurer, the insurance firm, and the policyholder, the individual or business who purchases the policy, which grants financial security or compensation to the policyholder in the case of a loss. In order to make payments of premium by insured more affordable, insurance companies pool the risks of its policyholder. One of the most significant inventions in human history is insurance. Stay tuned as we go into great detail about insurance. For more videos like this, do not forget to click the likes and subscribe buttons on our channel. Transferring risk from one party to another in exchange for a payment, typically referred to as a premium, is the practice of insurance. People can safeguard themselves against losses brought on by mishaps, catastrophes, sickness, or death by purchasing insurance. How did insurance develop? Let's investigate. Ancient cultures like Babylon and China are where the oldest types of insurance may be found. The Babylonian monarch Hammurabi published a set of laws that contained insurance requirements around 1750 BC. The regulation stated that if a merchant took out a loan to finance a voyage, he might pay an additional fee to have the loan cancelled in the event that the ship sank or was robbed. This type of marine insurance is still commonly used today. Similar to this, Chinese traders traveling along perilous rivers in the year 3000 BC divided their merchandise across numerous ships to lessen the likelihood that they would lose everything in the event of a shipwreck. This was an example of risk sharing. Another crucial idea in insurance. Insurance in Europe starts with trade guilds. Trade guilds were groups of artisans who shared a trade, such as blacksmiths, weavers, or carpenters. In the event of a fire, theft, accident, or death, they used the dues they had collected from their members to offer mutual aid. For instance, if a carpenter's workshop is burned destroyed, the guild would aid in its reconstruction or offer financial assistance. A market where merchants, ship owners, and underwriters could exchange risks and premiums. Lloyd's of London is regarded as one of the most important figures in the history of insurance. Edward Lloyd, who operated a coffee shop popular with marine tradesmen, started Lloyd's in 1686. Lloyd's quickly rose to prominence as a major center for maritime insurance and eventually added other lines of coverage. Fire insurance became popular after the Great Fire of London in 1666. Nicholas Barbin founded a business to provide building insurance following the fire. The creation of mortality tables, which are statistical charts that display the likelihood of death for various age groups, was another significant development in the history of insurance. John Grant first developed mortality tables in 1662, and Edmund Halley updated them in 1693. They made it possible for insurers to determine life insurance policy premiums more precisely based on the insured's age and health. As a result, life insurance became more widely used and reasonably priced. The global insurance industry now essentially covers every aspect of human life and endeavor. Health, vehicles, homes, travel, and pet insurance are just a few of the various types of insurance that are offered. Insurance enables consumers to manage uncertainty and lower their financial burden in the event of unforeseen catastrophes. Insurance contributes to social welfare and economic success by financing investments and safeguarding vulnerable people. Insurance premium. The sum of money you pay for insurance coverage is known as the insurance premium. Depending on your insurance, you typically pay your premium monthly, semi-annually, or annually. The premium you pay is influenced by a variety of variables, including the kind of insurance you get, your age, your health, your history of claims, your credit score, and more. For instance, if you purchase auto insurance, you would pay more if your vehicle is expensive or you have a poor driving history. If you purchase life insurance, the cost will increase if you are older or have a health issue. Insurance deductible. When you file an insurance claim, you must pay a certain amount out of pocket called an insurance deductible. For instance, If the cost to repair your car is $2,000 and your deductible is $300, you will be responsible for $300, and your insurance company will cover the remaining $1,700. The higher your deductible, the lower your premium, which is the amount you pay each month. Your premium will be higher the lower your deductible is. This is so that when you choose a smaller deductible, you're shifting more risk to your insurance provider. And when you choose a higher deductible, you're taking on more financial responsibility in the event of a claim. Sum insured, a non-life insurance policy, such as home or health insurance coverage, use the term sum insured. This refers to the value cap on the charges for which you have insurance protection against any unlucky incident. Sum assured, the sum assured is the sum that the life insurance company will pay to your nominee in the event that the insured's death occurs. Insurance, reinsurance is essentially protection for insurance providers. In exchange for a premium payment, one insurance company, the ceding company, uses this procedure to shift some of its risk or liability to another insurance company, the reinsurer. Reinsurance assists ceding firms to lower the likelihood that they will have to pay out big claims or go bankrupt in the event of a loss or disaster. There are instances when the risk is too great or complex for one insurer to manage on its own. Consider a powerful hurricane that hit Florida and leaves behind billions of dollars in damage. It would be hard for one insurance firm to be able to cover the losses if it sold every homeowner's insurance policy. Instead, the retail insurance firm uses reinsurance to divide up coverage among other insurers, dividing the expense of risk across numerous insurers. Types of insurance. Insurance protection is broadly classified into two: non-life insurance and life insurance. Non-life insurance. Non-life insurance, sometimes referred to as general insurance, property insurance, or casualty insurance, is a kind of insurance that protects you against losses or damages unrelated to life. Non-life insurance can assist you in recovering from the financial effects of some occurrences, such as if your home burns down, your car is stolen, your health declines, or you become legally liable. You should be aware of the typical characteristics and advantages of non-life insurance policies. First of all, they are founded on the indemnity concept, which states that the insurer would only compensate you for the real loss or damage you incur, up to the policy's maximum. Claims made under non-life insurance cannot result in a profit. Second, you must renew them annually to keep your coverage in effect because they often have a short policy term of 1 year. Third, they have a deductible, which is the amount you must pay up out of pocket before the insurance company pays the balance of the claim. Finally, they offer a no-claim incentive, which is a discount on the premium you get if you don't make a claim, as their fourth benefit. Depending on your needs and interests, a wide variety of non-life insurance products are available in the market. Here are a few of the most typical. Fire insurance. Your property is protected from losses or damage brought on by fire, lightning, explosions, or other risks included in the policy by fire insurance. Marine insurance. While being transported by ship, your goods or cargo are protected from losses or damage due to calamities caused by the sea, such as storms, pirate attacks, collisions, etc. Motor insurance. Motor insurance protects your car from accidents, theft, vandalism, natural catastrophes, etc., as well as your legal liabilities to third parties for any injuries or property damage they may sustain as a result of your use of the vehicle. Health insurance. Depending on the plan you select, this covers your medical costs for attending to diseases or injuries, as well as offering benefits for hospitalization, surgery, maternity, etc. Travel insurance. This protects you against financial loss due to unforeseeable circumstances that arise while you are traveling overseas, such as unexpected medical costs, trip interruption or cancellation, lost or delayed luggage, lost passports, etc. Liability insurance. This protects you from being held legally responsible for other parties' bodily harm or property damage as a result of your carelessness or wrongdoing while acting in either your personal or professional capacity. Life insurance. Life insurance is a contract between an insurance policyholder and an insurer that provides a designated beneficiary with a sum of money, the death benefit, upon the death of the insured person. The death benefit can also be utilized to cover final expenses, such as funeral costs and outstanding debts. If you are the primary breadwinner, it can also provide your family with money to live on after your death. All life insurance policies, regardless of their type, aim to provide financial security to your loved ones after your demise. Life insurance policies are broadly classified into two: term and whole life insurance policies. Term life insurance. Term life insurance is the most fundamental form of life insurance. Coverage is provided for a specific duration of 10, 20, or 30 years under this policy type. Your beneficiary will receive the death benefit if you pass away during the policy term. If you survive to the maturity date, the coverage will terminate and you will not get a death benefit. Whole life insurance. A form of life insurance known as whole life is an alternative type that exists from term life insurance, in that it does not expire after a certain period. Just make sure you continue to pay your premium. Your policy stays active. A major benefit of whole life insurance is its ability to develop a significant amount of cash value over time, which, in case needed, you are able to take a loan against the cash value of your insurance policy, as well as surrender it and receive its worth. You must take your time and evaluate the appropriate life insurance policy that will meet your needs and desires before a decision is made. If you enjoy this video, give it thumbs up and share it with your friends so that we can keep making them. For more videos like this, hit the subscribe button, and remember to click on the notification bell so that you get notified when we post a new video. Thanks for watching.